Today I want to talk to you about the government's Coronavirus Business Interruption Loan Scheme, or CBILS for short, which is designed to provide funding to small and medium-sized enterprises in order to survive this crisis period. Despite recent clarification from government, it is clear both from press articles and speaking with our clients that there remains a great deal of confusion around CBILS. In this video, I'm assuming you have the basic facts about CBILS, available as they are on the British Business Bank's website, and also doubtless filling up your inbox from various advisory firms, ourselves included. Instead, and based on countless conversations that we have had with both lenders and small businesses, I set out here to clarify some of the residual areas of confusion. I will cover off three topics: what you need to know about security, how banks are approaching CBILS, and is CBILS right for you? Security has been an area of particular confusion, and there has been a great deal of controversy surrounding the matter of personal guarantees, meaning that some borrowers have not taken the lending they require. On Friday, the government introduced a ban on banks taking personal guarantees on loans of up to £250,000. However, it should be noted that the larger banks were already not seeking guarantees on loans of this size. For borrowing above £250,000, banks may still seek a personal guarantee. While some banks are taking no personal guarantees, regardless of loan size, those that are typically seeking them from borrowers who would have to have provided one on debt taken before the crisis. Personal guarantees are capped at the value of the borrowing not underwritten by the government, i.e. 20% of the loan. It remains the case that banks cannot take security over your principal residence. Another change announced on Friday was that any qualifying business, i.e. those with revenues of now up to £500 million, can apply for CBILS, not just those who could demonstrate a lack of security. From our conversations with business owners, it is apparent that many are really not aware of how the government 80% guarantee actually works. Despite government backing, banks must still take all available relevant security over a business and its assets to the extent it is available. Borrowers must remember that the business remains 100% liable for the loan. If you default, the government does not step in straight away. Banks can only seek government money once they have exhausted all avenues to recover money from you, which is likely to mean liquidation. Think of it as follows. The government guarantee is to the favour of the lender, not the borrower. So, how are banks approaching this lending? First of all, businesses must be considered viable. As noted, changes have been made such that any qualifying business which was viable before the crisis can apply for CBILS funding. However, the emphasis is on viable. Businesses need to have been in good shape prior to the crisis and only in need of funding because of the crisis. It is not there to support businesses that were already struggling. Lenders will also keep an eye on affordability, particularly post-crisis, when businesses have to start paying this debt back. Some practical points to consider. Banks are looking after their own customers first and foremost. Whilst theoretically banks can take on new business, they are prioritising their existing customers, and so obtaining funding from a lender who is not your existing bank will be much more challenging. Unsurprisingly, banks are inundated with applications, and so are operating on a triage basis, identifying and then supporting those most in need first. In other words, loan applications are not processed on a first-come, first-served basis. Lenders have noted time and again that applications made by businesses being supported by their advisors are far stronger and more likely to achieve the right outcome than those from businesses making unsupported applications. So although business owners are rightly seeking to cut costs at the moment, it would be wise to consider the benefits of having an advisor help with what may be the most important funding application you have ever made. Finally, businesses should consider whether CBILS is right for them. It burdens the balance sheet with debt, which will ultimately require repayment. Therefore, it should only be considered once all other mitigating steps have been taken, such as deferral of VAT payments, time to pay arrangements for both PAYE and corporation tax, furloughing of staff, rent negotiations with landlords, capital repayment holidays on existing debt, and discussions with suppliers about deferring payments. I reiterate again, you remain 100% liable for CBILS debt, so make sure you can afford it and take advice. I hope this has been informative and gone some way to clarify remaining areas of confusion. The rules are changing fairly regularly, so do check back here for further updates. If you would like to speak with us about your or a client's business which is seeking CBILS funding, we have a team of experts on hand here who can guide you through the process and help you achieve the right outcome. Please do get in touch.